Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is performing and non-performing note expert Eddie Speed. Now, Eddie is the owner and president of Colonial Funding Group, which acquires and brokers discounted real estate secured notes. Additionally, he is also a principal in a family of private equity funds that acquires bulk portfolios of notes. Now, Eddie has dedicated his professional life to the seller financing and note industry, and over the 3+ decades, he has introduced innovative ideas and strategies that have positively impacted the way the industry operates today. And guys, with that, I'd like to welcome our guest for today's show, Eddie Speed. Eddie, how you doing today?
I'm good. How are you?
I'm doing great, man. Excited to have you here. Excited to just unpack your 3+ decades of note experience. I mean, it's quite a bit of time. You've been laser focused within that sector for, again, 30+ years. You've probably seen just about everything, I would think, probably multiple times over again. And so, I gave you that brief introduction, Eddie. I know there's a lot more to your background, your story. So maybe for those that aren't familiar with you, who you are and what it is you do, take a few minutes to tell us a little more about yourself.
Well, I started kind of seemingly backwards in the real estate business. I started out as a discount note buyer. That's what I started out doing in the industry. Mm-hmm. And I've made that my specialization over a long period of time. I've been involved in, real estate investing, but really because kind of backing into it from the note business perspective. Over the years, I chased the product that is the most advantageous for us to chase. Right now, that's probably seller financing, right?
Okay.
I chase institutional loans. I'm very connected. I have decades in this business, so I know lots of I know the channels, but right now, like bank type loans have been pretty thin. Like the market's been really thin in that availability. And I bought 50,000 seller finance notes, so that's kind of this rabbit's briar patch, so to speak.
Okay.
Right? And seller financing is quite on the way up. It is up almost 25% in the last 2 years. And that's really because of tight underwriting.
Mm-hmm. So, tight underwriting, but also obviously rates have gone up quite a bit. And I'm assuming sellers, if they want a certain dollar amount for their house, they can, it's like price or terms, right? And, give me my price. I'll give you some attractive terms better than what you might be able to get from a bank. Is that mostly what you're seeing, or?
I don't know. I don't see much of that. Most of the loans that I see are the guys that you and I know, Kevin. They're in one of the big masterminds. They use one of the vendors that you and I know, and they are a professional real estate investor, and they're creating seller financing on a recurring basis. So what I do for them is I show them how to take seller financing and PACE mortgage banking over the top of it, right? In other words, how to go identify the right property, which could be a house or land, good property, how to market to somebody that's been left behind, that's good, that's really a qualified customer, they've been left behind. Then I show them how to structure the loan. Then I connect them with the right vendors, from everything who they close with to their the underwriting services, the servicing services. I connect them to make them look like a mortgage banker, not a homemade seller financer. Then I can pay more for their notes because I've had an influence in how that note was created.
Understood. Very, very interesting. So, so I mean, you're really helping educate real estate investors really completely on the front end. I mean, even as far as like in their marketing strategies to acquire or buy new properties. Correct? Am I understanding that?
Yeah. So you and I were in CG together. That's what I do for guys in CG or any of the other masterminds that I'm in. I'm giving them a blueprint. Mm-hmm. That's why I bought 50,000 seller finance notes, and you can't find anybody else that's ever bought that many. Yeah. It's because I figured out how to build scale with it through my customers. Mm-hmm. Right. And then all of a sudden I'm building automation for them, and they're not accidentally doing it. And the good news is, Kevin, now I've created really good notes that when they sell those notes, I can pay them more money, but those notes fit my exit strategies better. Yeah. And that's when I use Note School, right? I go teach people how to buy cash flowing notes But once again, they're deals that are written with discipline, not kind of Harry Carey, so to speak.
Yeah, and I guess that professional real estate investor, they already have a clear understanding that literally you're going to come in if they structure it and follow your steps, that you're ultimately going to come in and acquire that note there after the fact. They know exactly. I'm assuming they have a clear picture of exactly what you're going to pay for it and what their overall return is going to look like before they even have completed the deal. Is that a fair point?
They know what a hamburger is going to taste like before they order it.
Yeah, I love it. I love it. What type of, just curious on your side, from the buyer side, what type of what's the approach as far as a discount, from face value? What does that typically look like?
Most real estate investors today need to sell loans at less than a 10% discount.
Okay.
Right? Otherwise, they can't afford to really do it. So once again, if they're structuring deals the wrong way, if they get 8% down and a 92% note, then all of a sudden I can't go buy that note at that kind of pricing because they've structured it the wrong way, right? And so I've learned and I've done this for decades, right? I set up the note system for home investors around 1990. So I've done this a long time with the thought in mind of helping people, how to go do it. We kind of forget, Kevin, we're in the real estate business, and all of a sudden when we sell or finance a property, we just jump the fence and now we're essentially a mortgage banker.
Right.
We just don't think about it like that. And I try to help them with that. I'm used to it. I love it. I have a passion for it. I think that's really kind of the impact that I can have, the biggest impact with real estate investors in the business. Then I have a school. So I have a lot of people that come to my school. To be honest with you, they're burnout landlords, right?
Mm-hmm.
They've had rent houses. They're not good at rent houses, or they don't want to be good at rent houses, right? They don't want the work. And so I kind of have a comparison that I can explain to people. You have $250,000 to invest. So come to my town, Dallas, Texas. What can you buy for $250,000? A rent house versus a note. So I can buy a rent house and it rents for $1,800 a month, right? I'm going to net about half that, which is other half's going to go to expenses, right? So I'm going to net about $900, and I'm going to have a pretty good commitment as to what you do, managing it, taking care, all of those things, right? Right now, $250,000, the average income it buys for $250,000 on notes is about $2,700 a month. That's the average income that a $250,000 cash deployment gets. So you got $2,700 or $900.
Yeah.
And less aggravation. So that's why people like notes.
Yeah. No, I completely understand. I really do. I can appreciate the expense load that you put on that single family, because I think a lot of folks lie to themselves in the single family investment space as to what that home, what that expense load realistically looks like, not just in a given 12-month span of time, but over a 5-year horizon. You got repairs and maintenance, you've got mechanicals that go bad. You've got reserves that you should be setting aside, right? You should be budgeting for future reserves for future CapEx improvements and what have you, roof replacements, things like that. So anyway, I think 50% is very accurate. I think a lot of folks probably underwrite those things and assume it's going to be 20 or 25%, which I think is setting yourself up for failure.
There's no mega season landlord. You and I commonly know 50 people that have 50 rent houses or more. Like between the two of us, we have a shared list, right? That we know well. None of them will tell you can operate at less than 50%.
Right. No, I agree with that. So talk to me about your business long-term strategy. What does that look like? I mean, you've acquired 50,000 notes over the years. I mean, how long do you typically hold them? What's your exit plan? Who do you pass them along to after X number of years?
So I have, I've been doing it a long time. We have essentially a little small family office. So we invest in notes. So we have a good reason that we want to make good notes and buy good notes, right? And then along with that, we have a school. So we have a lot of people with investable capital. And that's really an audience that I think I can serve well today for your guys if they want to learn how to buy notes. We really are note buyers. We're not some fast talking gurus, so to speak. I mean, we've been in the space a long time. We are in the space. We'll buy between 750 and 1,000 notes this year. So
Wow.
we're not talking about something we did in the past and never plan to do again. And then there's times when people will bring me a deal and it's a capital fund or it's an insurance company. Like there's other connections that I have depending on the level and the size of the portfolio that somebody has. But we've got they call that in your space, right, the capital stack, right? So I have multiple capital stacks depending on what product it is. And but I found this: if I'm only investing my money, I'm limited in my intake. But if I'm helping my students at note school or an insurance company, if I'm helping them invest their money, then I can have a pretty wide path in how I help people in the marketplace and buy their notes. And then I just go place that loan in the right spot that is the best place for whoever's going to buy it on the other end.
Mm-hmm. Give me some criteria. Give me what that buy box or that note box has to look like in order for it to make sense for you. I mean, is it geographically constrained? I'm sure the quality of the home, maybe year built, size of home. Just what does that box look like?
So I tell people the waterfall is pretty simple. You start out with a good property, right? So I don't deal in substandard notes secured by substandard real estate. There's land gurus out there teaching people to chase swamp lots and desert lots that are you can't do anything with them. You can't improve them. That's not good paper to me, right? I want people to deal in good standard of resi houses that they're selling houses, right? Not something in some unrealistic crime area or not some property that you can't sell poor people a house that they got to go spend 40,000 and fix, right? So you got to fit. I want that property to be sacred to the buyer that buys it, and I want them to be able to fulfill their dreams on it, whatever that is, right? So I start out with a good piece of property, and that leads me to a good buyer. Right now, mortgage banking is crazy tight. Before the virus started, the Mortgage Credit Availability Index, that's mortgage banking's little index that they built, it was at about 185. Today, it's at 100. So underwriting is that much tighter than it used to be. And there's a lot of people with good credit and good job stability and deserving of a home that have been left behind. We serve that market really well.
Got it. And what does the average default rate look like in your entirety of your portfolio? I mean, what is it a single digit number?
Yeah, it should be 2 to 4% depending on the economy.
Got it.
It's let me say this. It's better than FHA's.
Sure. No. And what is FHA? I don't follow that data, but just curious.
FHA's delinquency now is about 11%.
Wow. Interesting. Okay. I was not aware of that. And that's FHA is what, 3% down, 3 or 5% down?
Yeah.
Typically.
But they're stringent on some things where they're not good at all. We do really well with people that are on commissions, people that are self-employed, people that fit those things, that have good credit and all that. They're just not, they won't pass the forensic audit of traditional loan origination. And that doesn't mean we don't underwrite. It doesn't mean that we don't connect them with a professional underwriter, but it still means that we still are allowed some common sense things that we know statistically over a long period of time that customer performs well. We don't want to help you seller finance a property if it's not going to be successful with the guy that's buying it from you.
Sure. And we're only talking about first lien notes, correct? First place? Okay, got it. Yeah, very interesting. What does the world look like out there today? And as far as like seconds, is there a world of non-performing seconds that still exists, or is that few and far between as well?
Not much.
Okay.
There wasn't. The reason those non-performing seconds were originated in the last cycle was when they were doing a subprime first and they couldn't get mortgage insurance, and then then the bank carried a piggyback second, and that's how those loans came into the marketplace. So there's always some product, but it's not like there's some massive amount of it. We do buy NPLs. We buy non-performing loans. We have good training. We have good systems and processes for people to do it. The market has been really thin for the last about 3 years. And we thought it was really going to blow open this year, and it didn't. But we kind of believe that it's going to really loosen up next year. So it's not that doesn't exist. It's just I always want to be careful to promote something that's real and doable, and the market has a level of available inventory that pursuing it makes sense. So we teach it. And it's part of what Note School teaches. But right now, what I found is people want cash flow without a headache.
That's right. Yep. I love cash flow. Hence the name of the show. Talk to me about your business in, I guess 9, 10, 11, 12, after the GFC. I mean, what did not performing notes? I'm sure that you had more than you could even attempt to buy. I'm assuming at that point in time. Talk to me about that period. I would just love like the chaos, the organized chaos, probably that ensued within your organization. Probably a beautiful symphony. I'm assuming.
Yeah, it was. But let me tell you that it was also difficult to price loans in that market because you're pricing a dropping knife, right? You got to price a non-performing note, and by the time you get to the collateral, it's worth less than when you bought it. And so every opportunity has its challenges, right? And so that was an era. I bought non-performing loans in the 80s. I bought non-performing notes in the 90s, and I bought non-performing notes in the early 2000s after '08 all the way through about '09 through about 14 or 15 is kind of when a lot of that inventory kind of played out a little bit. And then I've always done seller financing, and then I buy reperforming loans from the banks. Right now, those loans are trading for too much money. It's not that I can't buy them. I know where to find them. They're just buying loans at lower yields, and really we can do better with seller financing and a little higher return with the same quality of loan. So we just have to, as you just got to go pick certain things depending on what the market's telling you.
Yeah, I mean, I think you just have to adapt to the times, right, and pivot to the times. What's a reperforming loan? I'm not familiar with that terminology.
So during the virus, there's about 8,000 loans that became non-performing, right? Well, 6,000 of those loans modified. So they got current again, and now they're paying again, and they're called reperforming loans. RPLs is what the industry calls them. And so they're out there, and I know all the veins to go find them, but they're buying those loans at lower yields, and a good bit lower yields than what we're able to do. I've done so much seller financing. I understand the product. As you know, I'm kind of connected in that world.
Yep.
So that's my spot. And right now that's an underserved market, and I do well at helping people really mechanize it. And so for those reasons, it really has helped, in how I go about it.
Yeah. You made a comment related to, you thought by now, maybe the defaults would have, risen quite a bit, but that just hasn't occurred. But you're thinking maybe in the next 12, 24 months, we'll see some pain and some distress. I mean, what does your crystal ball tell you?
2 million loans are not paying today, and delinquency is on the rise. But the problem in the non-performing note space are not fresh delinquencies. There's 250,000 loans that are in some facet of foreclosure right now with an average, listen to this, with an average days delinquent on a loan that's in foreclosure of 1,250 days.
Oh my gosh. What the hell's happening in that scenario? What's the situation there where it goes that long and doesn't make it all the way through the foreclosure process? That's 4 years.
Some people say it's political.
Interesting.
No, the government doesn't want all that, doesn't want all that stuff to get pushed yet.
I mean, I guess in the grand scheme of things, 2,000, no, it's really not, that's not a huge number in the grand scheme of things.
250,000.
250. Okay. I was going to say okay. That's
250,000 loans.
That's a bigger number.
Facet of foreclosure.
The 50,000 part, it got cut off. So 250,000.
No, it's pretty important. Yeah. It's 250,000 loans. So, yes, we think there's going to be a waterfall of those, and we're watching it. And so this is kind of like you can kind of see I have different lanes, right? We have a really much more passive with better cash flow lane that Note School takes people with investable capital, right? And we do well and serve them well at teaching them what we do. And then we have done for you and we help them go find the assets. Because remember, I'm the guy out there with some real estate mastermind every week showing people how to go make good notes. So that all of a sudden I've built a flow of those notes. Then we have people more like you that are more sophisticated, more in the business, more committed to it. And we'll teach them either how to create seller financing or we'll teach them how to buy non-performing notes, right? So we've built different lanes depending on how we can help somebody.
Yeah. So for someone who wants to come in and buy their own notes, they want to get into this business, they want to purchase, they want to acquire some, whether it be performing or non-performing. What's it? I mean, is there any compliance requirements of actually owning notes? I mean, is there a piece there, and then also like the servicing, and how does one manage all that?
Well, that's why we built a school. You can't go read it in a book, and I'm not sure I'd believe it if it were on Facebook because there's a lot of myths out there on that. I'm just saying,
Sure.
So the answer is that's why we built a school 25 years ago, is to show people how to go do the business. And we have people that come to Note School that want to just go learn how to do it, and then they leave and they're going to go do it all themselves. Then we have people that come to Note School and then they want to come do it along with us. In other words, they want us to help them with connections, compliance, marketplace circumstances, all those things they want us to help them go do. And then we have people that come, and so I call that middle category, that second category, I call that an incubator, right? Where they're sort of an incubator with us. And then we have people that come to Note School that are super busy realtors, they're a dentist, they're a business owner, they're this and that. They've had rentals, they don't love that. And so now they come to us, and what they want us to be is they want us to give them the get me the solution button. In other words, they don't want to watch 4 football games on Sunday. They just want to watch ESPN Sports Center, right? And so we serve that, and we call that done for you, and we serve them really well. Those categories are kind of our 3 categories that Note School helps with.
Got it. No, that makes sense. Is this mostly only applicable to residential real estate? I mean, I know your business sounds like it mostly is, but what is the opportunity in the commercial world for seller held notes? I mean, and we've structured a number of seller held notes on mobile home parks that we've purchased, right? Sure. But we owner still holds that note. We're still paying on the deal. It hasn't been. I guess the question is there a secondary market for that world as well?
There is. Obviously we're watching commercial real estate, and some asset classes are far more bruised up than others.
Yeah.
And so we're trying to pay attention to that and figure out like when we can really be helpful and help buy some notes on the commercial side, and when we just need to kind of keep the pause button on and let the house burn down a little bit. I like your asset class, quite honestly.
Yeah.
And I'm helping a deal right now. In fact, our mutual friend, Corey, he's brought me in as a consultant to help negotiate the terms on a mobile home park right now. Right.
Oh, great. Deal.
Multifamily is probably going to take a little more clarity. You better. It's not saying there's not any bargains in multifamily, but there's a lot of things that you better, as you well know, you better be paying attention to.
That's right.
So I've been around a long time. We're trying to just make good decisions. I buy a lot of land paper. I've bought a lot of land paper in my career. I probably bought 20,000 land notes.
Just undeveloped land, raw land?
Country land. I like country land. Like people buy land, break it up and sell it to people that are going to buy the land and go live their dream on the land. It's going to be their retirement property. It's going to be, they're going to move out there. They're going to raise their kids on dirt, not concrete, kind of that kind of thing. I don't like some of the gurus teach, buying this, little subdivision land where you couldn't really ever, you legally, for the size of the lot, you can't get water, you can't get power, you can't get septic. Like you couldn't develop it. I'm not that. I
Yeah.
like country land where people are going to enjoy it. It could be weekend property, it could be their new home. They're going to put a mobile home on it and stuff. And I have a lot of experience in that asset class, and there's a big network, as you know, in that space, and
Mm-hmm.
we work that group as well.
Gotcha. Okay. Lots covered here, Eddie. Anything else, just generally speaking, from a high level perspective that we should have talked about that we missed on?
I think we are a really good alternative. So if somebody is like investing in your business, right, and I think notes are a good alternative. Not to go abandon your space or just chase our space. I'm not saying that. It's a good alternative. If you're looking at diversifying your money, I think that your asset class and then notes along with it is a good fit. So I think Note School serves that audience pretty well. We have a lot of people that come from your neck of the woods in that area, and that we feel like we help. So we do have a master class if the audience is interested. If it's a fit, it's a couple of hours, and it's pretty informative. We give them a lot of case studies. We give them a lot of sense of what that looks like. I think people leave there with a clear understanding of what it takes to go really do this. Like how could they apply it and how could we help them?
Got it. Now I'm assuming noteschool.com, is that the website, Eddie?
Noteschool.com/sunrise.
All righty. I love it.
We picked because we do sell this masterclass. But you have a very respectable audience, and we wanted to do something that says just because it's a gift doesn't mean it's not valuable. So if you register, take it seriously, please.
Yeah.
But I'd just say that it's good. You won't feel like your time's been wasted. It's very informative.
I appreciate that. We'll get that in the show notes as well. Just curious as to what do the returns look like today? Someone came in and said, "Hey, Eddie, I've got $500,000, $1 million, but whatever. I want to buy some performing notes. What is there a different quality structure based on the how long the note's been seasoned, the asset it's tied to, of what type of return they're going to receive?
10 to 12. 10 to 12.
Okay. That's respectable.
And all of that's going to fit within. So they're not all the same. And when you kind of see different notes, I always tell people don't get drunk on yield, right? So, most people that have in their mind yield numbers, they can't actually even tell you how much interest that would make. So we go down, we're good at breaking down the money and saying, look, you buy this note, you're going to make this much money in the next 5 years. And when you look at it, there are very few things they're going to say that have that kind of it's not just get a return, but you get your principal back. It's an amortizing investment. So you're getting your investment money back too.
Yeah. And I guess along with that note, are they getting credit information for the borrower as well? Like all those details?
Yeah. Whenever we tie a loan up in due diligence, then we have a waterfall of things that we do in underwriting. We bought 50,000 notes, so we kind of have a sense of what to gather up.
You know what you're doing.
Hopefully.
Hopefully, right. And then the average, I guess, term, are these 5-year balloons, 10-year balloons, or do some of these carry out fully amortizing over 30 years?
We have both, but probably the average term is about 10 to 12 years is probably average. So some people buy really long-term notes, and there's people say, well, I would never want to buy a 30-year note. Well, guess what? The average payoff is 12 years.
Yeah.
Excuse me, 8 years.
Mm-hmm.
And so if you buy a 12-year note or a 30-year note, you still won't probably get it paid off in 8.
Right. They're either going to sell the place or refinance. So
there's reasons that you would want to buy a long-term note sometimes. And we have modeling that we teach in that and stuff. So, I always say, if we can get people just to show up, just okay with being a sponge, let us kind of show you what we've thought about a whole lot, things that we like and why we like it. And usually people leave there and go like, you know what, I didn't think about it the way they were thinking about it, but as I got their logic, it made sense to me too. So we're pretty good at that.
And that's that masterclass. We can get some of the basics in that masterclass of what you're talking about here.
Yes, sir.
Eddie, this has been a lot of fun. I appreciate you coming on the show. Appreciate you sharing your insights and just, multiple decades of knowledge on the note industry. Again, noteschool.com. We're going to put that in the show notes. It can also access the masterclass at noteschool.com/Sunrise. Is it Sunrise Capital or Sunrise Capital Investors?
Let me check. Let me check. I want to make sure.
Make sure we get it right. Yeah.
I believe it's Sunrise, but give me 2 seconds.
Okay.
It is Sunrise.
Okay, perfect. So Sunrise, we'll get that in the show notes. And then is there anywhere else to track you down? Are you spend any time on any of the social channels or anything else you'd like to share?
Yeah, we have a great podcast called Note School TV.
Okay. Right.
And it's very specific to our business. So we'll have students on there sometimes, or we're on there teaching. We have a market updates once a month at the last week of every month. And we spend a lot of time and energy talking about real estate markets, financing markets, trending as to it's a weather report. We're trying to make sure that we can read the weather report. So we do this for ourselves. And we got to where it was like, hey, we might as well just share it with the audience because they seem to love it. So
that's right. I love it. Well, awesome, Eddie. I appreciate you coming to the show. It's been a lot of fun having you, my friend.
Thank you.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.